This process of a weak dollar and a strong Japanese yen could once again trigger the issue of unwinding the yen carry trade.
Nice to meet you, dear viewers of the Elder YouTube channel. This is stock investment expert Byung-Hyun. Fed Chairman Powell continues to reverse his position between lowering interest rate and maintaining high interest rate. It makes sense to try to achieve maximum employment and price stability, which are the Fed's two responsibilities. But I think it's Powell's position that has recently been put on a dead end to reverse the opposite position. As prices such as PCE rise, he has to maintain high interest rate, but the job market is likely to collapse. So he says he will cut interest rate. In these difficult situations, let's check Powell's position and the flow of the international market.
Comparing soft data and hard data, the discrepancy between the hard and soft data is the reason many people currently predict a recession and the data that has not arrived yet. Soft data is highly subjective, usually through survey or questionnaire or evaluated based on various data sources such as the Consumer Sentiment Index or Leading Economic Index. Hard data is highly objective, calculated using a formula, and includes indicators like the unemployment rate and the retail sales index. Currently, soft data like the Consumer Sentiment Index and the Leading Economic Index have been in a downward trend for a long time. But hard data like the unemployment rate are showing a solid trend. Interest rates have remained high for a considerable period of time, significantly dampening consumer sentiment and worsening the economic outlook. This is why soft data appears to be deteriorating. However, direct deterioration in economic indicators such as deteriorating operating performance or rising unemployment rates is not yet visible. Ultimately, the reason the stock market is currently healthy without any stock price corrections or recessions and bond yields are not falling is because the collapse of hard data has not been directly visible. However, given that hard data inevitably follows soft data, I believe hard data will also collapse at some point. Soft data has already deteriorated significantly, so it seems necessary to prepare for this. The stock market and bond market followed the same pattern in 2001, 2008, 2020, and I believe the same pattern will continue today. Back then, the stock market declined, while the bond market rose as bond yield fell. While such a trend is not currently visible, I believe a trigger event will occur. In 2001, the September 11th terrorist attack were the trigger, and in 2008, the Lehman Brothers bankruptcy was a trigger. I don't know when or what the trigger event will be today. However, as always, the trigger event will inevitably occur, and I believe it will lead to a recession. In preparation for this, I'm increasing my bond holdings. Powell. At the July 13th FOMC meeting, Fed Chairman Powell acknowledged weakening labor market demand, but also noted that immigration is decreasing due to President Trump's immigration policies. The labor market is considered balanced and stable, with labor demand decreasing, but labor supply is also decreasing. Therefore, Chairman Powell stated that tariff will be introduced starting this summer to prevent inflation. The Fed downplayed the possibility of rate cut, predicting a high impact on prices and a limited surge in unemployment rate in the labor market. Furthermore, given the high government debt, government spending, and the high mortgage rate, which are holding back prices, the Fed responded that lowering the benchmark interest rate preemptively would actually lowering prices. The Fed responded that price stability and maximum employment were their responsibilities and that other issues are not their concern. Based on Chairman Powell interviews, I suspect that high interest rate will remain in place for the time being unless there are sharp deterioration in the labor market, such as a sharp rise in the unemployment rate. However, this assumes that there is no significant deterioration in the labor market. My personal view is that given the prolonged high interest rate, the worsening labor market is inevitable, and this could gradually increase the likelihood of a rate cut. We plan to continuously update data on labor market trends, so it would be helpful to keep an eye on them. The issue of unwinding the yen-yen trade is also becoming more apparent. President Trump wants a weaker dollar, and the Bank of Japan maintained its policy to raising interest rate. President Trump has repeatedly asserted that a strong dollar helped curb inflation, but only to the point of being ineffective, and that he wants a weak dollar which he believes will generate a significant income for the United States. In Japan, inflation, which has been absent for decades, has recently resurfaced, making life difficult for ordinary citizens. Consequently, the Bank of Japan has moved away from the negative interest rate it has maintained for several years and is continuing to raise interest rate, while it is currently holding off on raising interest rate to excess. The effect of tariff negotiations and tariff on the Japanese economy. If the yen weakens and inflation continues, the Bank of Japan is expected to raise interest rate again. This process of a weak dollar and a strong Japanese yen could once again trigger the issue of unwinding the yen carry trade. Today, I shared my personal view on the stock and bond market based on soft and hard data, Chairman Powell's remarks, and the issue of the yen carry trade liquidation. These are my personal views, so there is high chance I'm incorrect. So please leave your comments and I will humbly accept and review them.